Welcome to the Finimize podcast. I'm your host, Carl Hazley. Now, my guest for this episode is about the closest thing you can get to a celebrity in economic circles. Sree Kochugovindan, senior research economist at Abrdn, in a given week has been on CNBC, Bloomberg, and Breakfast Business. So we're delighted that she's been able to join us here in the studio today. We discuss what on earth has been going on in markets, taking apart the recent crazy moves, putting it back together again, understanding central banks, and how to make a coherent investment strategy out of it. So let's get into this episode with Sree Kochugovindan. Sree Kochugovindan is senior research economist at Abrdn in the Research Institute. We're delighted to have her here. Welcome to the Finimize podcast.
Thank you for having me. Thank you.
So summer's meant to be quiet. It's meant to be the point where everyone's on holiday, not much happens in markets, don't come back until, late September, maybe October. This summer has been anything but. We've just seen some very crazy moves in markets, comparisons to Lehman going under, to the dot-com bubble bursting in some circles. What on earth has happened?
Right. Well, it has been quite eventful, but I think it's important to take a step back and break it down and just see, is it worth a big panic? There are reasons for concern, but let's have a look at what's been happening. So if we take a step back to last week, there was some pressure building into last week. And I think really what's escalated this is, what is happening with the Fed? What is happening with the US economy? And those are the key questions. So last week we had a very eventful for investors. We had three major central banks making announcements. Bank of England was one, Fed didn't make a change, but did signal a very clear signal for easing policy from September onwards. And then we had the Bank of Japan, which is quite key in all of this. But then on Friday, we had an employment report from the US, which did cause some concern for investors. So it started to escalate around Friday. Now, what happened is you have US non-farm payrolls. And that's important because it gives you a steer for how hot or how loose the labour market is. And that number, that payrolls number, was far below what consensus forecast was, what the expectations of market. And from there came some of the concerns about the Fed and were they behind the curve? Should they have eased sooner? Should they have started in July or even before? And then the speculation over the weekend was, will they go 50 in September? Have they left it too late? By Monday morning, overnight, and I think Japan is quite key to all of this, we started to see a sort of hemorrhaging across risk assets overnight. And then really the big move was in currencies, it was in the yen. So I think that's something that we need to really stop and think about in terms of Japan and how that impacts everyone.
Got you. So maybe let's work our way around the world and almost chronologically. Let's start with the US and the Fed, and I guess with that jobs report, because on the one hand, we've had a couple of months now where jobs have come in slightly weaker. On the other hand, there were potentially some weather impacts. The survey itself is a relatively blunt instrument. If you're not there on the 14th, happening to be working or looking for work and so on, you drop out. And so there's all that to take into consideration. Is it fair to say that the response to the jobs report alongside everything else was perhaps, I don't want to say unnecessary or too dramatic because, we are where we are. But with the benefit of hindsight, it seems like it was a bit much ado about nothing.
Well, I would say we do need to be cautious and humble to this data. But as you say, let's look at the details within it. We've had the Fed, central banks across the world, really having to respond to big inflation pressures over the last 2 years. And those inflation pressures are unwinding. Now, part of that story was really tight labour markets, very strong employment, and very strong wages. So that was really feeding into this inflation story. So that's where the focus had been. Now, inflation is starting to ease off quite nicely. We've got a good disinflation trend. And as part of that, necessarily, we do need to see labour market dynamics changing. So you need to see the very strong demand that we had for workers and very low supply. We need to see that gap being bridged. There is a normalisation in labour markets. But what we've seen in the last 2 to 3 months in the US is that, yes, unemployment is creeping up. The demand for workers in terms of vacancy rates, that's starting to decline. But this that had been interpreted as good news previously, because then it means the Fed can ease. They can start to undertake that path of policy normalization. Now, this particular report, one thing was it was below consensus. There was a big gap there. And there were downward revisions in the prior months. That's one thing. The second thing is there is a bit of a hurricane impact potentially. As you say, it's like on the date of the survey, there were higher sort of temporary layoffs. There was some hurricane disturbances reflected that could unwind next time. So that's the second thing. But nonetheless, it was a weaker report because, in terms of the breadth of the slowdown in employment across different sectors. So there is a clear trend there of the labour market turning. So that is true. But there's also there's a lot of focus at the moment on the SARM rule, which is where the unemployment rate actually sits relative to the last 12 months, the lows of the last 12 months, and if it hits a particular trigger. So that trigger was hit this time. So then that was a bit of an alarm bell. Now, Claudia Salm actually came out on Friday and said, well, yes, it's hit the trigger, but you need to read this
over
carefully.
a longer period as well.
Go over longer. You can take the rule, but then look at everything else that's happening as well. So let's look at the other data. So there was one payrolls report. There was some weaker data in terms of other jobs reports. So you have this weekly indicator called the initial claims. You have another survey, the ADP survey. That was also weak. And then within business sentiment surveys, you have like what we call the PMI or the ISM survey in the US. The manufacturing sector showed weaker employment. You put all of those together, okay, this is a deceleration. Yeah. But then if you look at GDP, the activity data was actually relatively strong recently, and that was consumer spending, business spending. And that's historic data. It's not leading indicators. But we need to balance all of this information in general. So you need to look at the more frequent consumer sentiment and consumer spending as well. So that is still to come. So we do need to be careful and monitor the dynamics in the US. And it's just the timing of it. We had the Fed signaling that they could be easing. It was more of a dovish tone, even though they didn't move. But the market pricing for future expectations of the Fed policy, that shifted very dramatically and very quickly. And that had this sort of sentiment response. And then you get questions such as, well, stock market's turning. What does this mean for the net wealth effect? For the US consumer, does this mean that they suddenly stop spending? All of these things filter through over time. So we don't have enough evidence yet, in a nutshell.
All of this, of course, exacerbated by the fact it's the middle of summer and volumes are thinner. And what I find just peculiar, interesting, what have you, is, rewind a couple of weeks even, and part of the conversation was, well, the US is fine. Things are, the labour market is slowing. We're seeing a couple of indicators showing a deceleration. That's exactly what you want. Why even cut rates at all? And fast forward a couple of weeks and it's, can we do an emergency 60 basis points, Monday afternoon over tea and crackers? So it's funny how quickly some things can change. It's funny how quickly sentiment can change. But as you said, it's sentiment is almost by nature short term, and coming back to the fundamentals, understanding where the US economy is gives you a better sense of where things are mid and longer term. Okay, so let's maybe hop on a metaphorical plane over to Japan and understand where the yen fits into all of this and what the Japanese central bank has done that's played a part in the last few days.
Yes, so this is actually a key piece of the narrative and driving sentiment at the moment. So just a bit of context. Japan has gone through decades of deflation and low inflation, disinflation. But over the pandemic, they did manage to generate above target inflation. But when I say above target, I mean in Japan, you're looking at 4.5% headline rate relative to the double digits of some other developed markets. So again, within context. But, this is a potential turning point for Japan. And so it did create a lot of excitement in terms of investors looking at JGB, the Japanese government bonds, the currency, and equity markets, because they have a lot of corporate reform as well. So the equity market looks quite interesting, and it had a massive rally last year. So all of this is the backdrop. Now, the Bank of Japan, because of decades of deflation, they've had to keep monetary policy extraordinarily low. So you had years of policy rates at minus 10 basis points. And they also had additional policy called yield curve control, which was where they're literally pushing down on the yield across the bond market. So you don't just hold down your short-term rate, you're literally controlling yields across the curve, keeping them low. And that's to help generate demand and generate spending, which will then lead to, most importantly, domestically generated inflation. Yeah. And that's what that's what they've been struggling with in the last few years. So you have imported inflation through food and fuel prices, but the Bank of Japan, central banks cannot respond to that. They need to react to domestically generated inflation. So this has been the story so far. Now, the Bank of Japan have started to remove some of the stimulus, and they've raised interest rates, and they raised interest rates last week. A bit sooner than people were expecting. So they did surprise the markets a little bit, and it was more than the market had priced. So that was all big news. What does this mean for the currency? Now, the currency, so if you take yen relative to the US dollar, the main driver for that is interest rate differentials. So where you have negative to zero rates in one country, 5.25 to 5.5 in another, and across other DMs, you've got this massive rate differential, which then means that the yen becomes a funding currency in which you fund to invest in other trades, whether that's other risk assets, other currencies, emerging markets, the rest of Asia, and so on. So there has been this growing concern. What happens when that yen carry trade unwinds? And I think that was part of the fear from last week as well, because you had weaker growth in the US, but the Fed didn't move. Yeah. Was that a policy mistake? And now the Bank of Japan have been quite hawkish as well. They did have a very hawkish tone. They said, yes, we're hiking now. It's a surprise. We're going to reduce our purchases of Japanese government bonds. So, bond yields will allow them to slowly, very, very slowly rise. Yeah. So there was a lot made of those two things. But what I will say is that the Bank of Japan and the Ministry of Finance in Japan are very conscious of the global role that their currency plays. And the path of removal of this policy that they announced, the rate at which they will reduce bond purchases, was very, very slow, and actually slower than people had anticipated. The reason for that is they don't want to distort bond markets. But sentiment turned much quicker. So the rationale there, you still have a massive rate gap. Even if they go to 0.25 basis points.
It's still basically free.
It's still very weak, and we still have a massive gap. So this is a sort of looking ahead and front-running the future moves. So what they could do is the Bank of Japan and the Ministry of Finance are having emergency meetings. They had them this morning. Yep. We've seen a bit of a rebound in the yen versus the yen was rallying. That's retraced a bit relative to the dollar, euro, sterling. Japanese equities were the biggest sell-off yesterday, biggest mover today. So there's a bit of rebalancing there. So what does this mean? So you've got central banks, but you also need to look at positioning. And I would say that move in the yen relative to the dollar, that move from, say, 140 to 161, that was a lot of speculation and pressure on the BOJ. The Ministry of Finance had to intervene. So this was the run-up in the last month, and then suddenly that move pulls back. But it's like a knife dropping. I'd say that a lot of that move, that vertical move, does look like positions that have just pulled back because the Bank of Japan moved, and then they were very hawkish. So I would say that we need to look at the moves within the context of what's happening in central banks, but also how were people positioned before, and have those positions cleared out. And we'll get a better sense of that this week.
Maybe to spend a bit of time on positioning for our listening or watching audience, and just to put some meat on the bones around how that carry trade works is if you can borrow yen short term, let's say, for 0.1, let's just call it 0.1 for argument's sake, and you can invest in the US and get 5%, that's a no-brainer. That's an easy trade. And when you have an easy trade like that, where you can make 5% with your eyes closed, the easiest way to make more than 5% with your eyes closed is to use leverage. And so people will borrow a bit, to borrow the yen, or borrow yen, leverage it up, and trade it against another currency. And so what you then have is, and whether that's the US dollar, euro, exactly like you said, if you're in the US, maybe you've also, been like, oh, well, I'm going to be long Nvidia, I'm going to be long Mag 7, I'm going to be long NASDAQ, and et cetera, et cetera. And what you end up in is, very crowded trades, i.e., positioning is concentrated. A lot of investors are all doing the same thing. And so when there's an unexpected move, and, we've spoken about the unexpected the unexpected or the questionable decision in the US around rates. We've talked about the unexpected move of the Bank of Japan. All of a sudden, the shift in how much it costs to borrow that Japanese yen means that your carry trade's a little bit less profitable, but throw in leverage and actually it's potentially a lot less profitable, and depending on exactly how you're positioned, maybe you're losing money. And if you need to somehow wind that back a bit, well, how do you undo leverage? You've got to pay some of that money back. How do you pay some of that money back? Well, you sell some of the stuff you own to free up some cash, right? What's the stuff you own? It's Mag 7, which granted, there was already a sort of trade out of that, but this wouldn't have helped. It's US stocks, it's the dollar, it's Japanese stocks. And so they're down 12% because people are trying to, get out of the risky stuff in order to buy back their yen because it's more expensive now, and that trade isn't working, which is a little bit, if you've seen the movie The Butterfly Effect, or just the concept of the butterfly effect, all of these things are interconnected for better or worse. And that's exactly, to your point, just to... where does the Bank of England fit into all of this? Because that's been a big move over the last couple of weeks as well.
Yes, I think the Bank of England may be less involved in this recent sort of drama in the markets, but I think it was still a very interesting story for investors in the run-up to last week, because nobody really knew what they were going to do. And I think the markets were priced pretty much 50-50 for some time in terms of whether or not they would start the easing cycle.
Worth saying you were more leaning towards the direction of a rate cut.
Yes.
So not only are we in the presence of a celebrity, we're in the presence of an accurate economist, which is...
well, our team, yes.
Okay, yeah, well, your team. But
yeah. Yes, so it was a very close call. And I think that was part of the dialogue of last week, really. And again, it goes back to this conversation about inflation and labour markets, and that's the root of, for a lot of central banks at the moment, that's the root problem. So in the UK, we've seen again this disinflation trend is on the way, but you still have slightly sticky services inflation, and wages are still a bit elevated, but they're coming down in the correct direction. And there's some signs of labour market loosening, but not too aggressively. So it was on balance. We did expect a very close vote. So in the Bank of England, it's very transparent. Actually, you have 9 members, and they all vote, and then you can see who has voted and how they voted. And the vote was 5-4 in favour of easing. I mean, last month, the last prior meeting had been 7-2, but there had been some signals that it was on balance, very close for some of them. So they've started the easing process. However, they have still said that they've cut 25 basis points, but the messaging was still quite restrictive. So I called it a hawkish hold. So there, it was very restrictive for a meaningful period of time. So that's signaling that yes, they have started easing, but it will be at a very slow pace. So they need to wait and see what the data is going to tell us over the coming weeks, months, before we can see another easing cycle. So that's something to consider as well.
And so it sounds like it's probably, on the one hand, investors seem to have turned a corner and are getting more optimistic on the UK, but on the economic front, it sounds like it's perhaps too early. So I guess, story of our lives, which is investors jumping ahead of the economic reality, is that?
Yes, I would say that in the recent, since, so that was on Thursday, but obviously events have overtaken, and I'd say that the UK is not so impacted. UK assets are not so impacted, is not so big a story. So there's spillovers. And I think ultimately the focus is really about the US economy and how that spills over into potentially a global recession people were talking about just a couple of days ago. So those are the concerns there. But specific UK story this week is very much, well, the Bank of England has started easing. We spoke a little bit on terms of the fiscal story. We've got a new government. We have a new chancellor who has been talking about the fiscal gap. There is very little space to spend. They're quite centrist, they're quite sensible in terms of looking after the future debt dynamics. So there are few fears there in terms of, what if they do something that could impact bond markets. There's political stability at the moment, I'd say, priced in for the UK. But there's very little space there. And there's talk of, how are policies funded, where are the tax hikes coming from? So that's something that will over time start to get some clarity over, and there'll be a budget at the end of October that will become a focus.
Yes,
over time. Yes.
Okay, so you mentioned something there about, I guess it comes back to the US and the risk of potentially recession or what have you spilling over, and how the US impacts the rest of the world. Let's assume, and it's not a big assumption, but let's assume the US avoids a recession, at least in the near term. I guess the big question beyond some of the machinations of the last few days is the presidential election.
Yes.
And, your views that Donald Trump's likely to win a second term on balance. Now, we had Paul Diggle on the Finimize podcast not too long ago, and we spent a bit of time on what a Trump presidency might look like, but it's probably worth revisiting in the context of us now knowing who he's up against. What are the scenarios that are at play here in terms of a Trump presidency, and how different could it be from, a Harris presidency, which is essentially Biden Part 2? Yes,
I'd say obviously, because that was before this drama that we were just talking about. It was all about the Trump trade and how the announcement of the nomination of Kamala Harris as the Democratic leader, how that could shift the Trump trade. So what is the Trump trade? And I would say that ultimately it would depend on whether or not the Republicans get a clean sweep or they have a split Congress. So we do have a number of different scenarios. And I think Paul would have outlined, the different, full-fat Trump versus, a more market benign version. And I think it's really a case of, the tariffs are likely across all three of those Trump scenarios. But also that would have a sort of shift higher in terms of prices, so that we'll start to see in markets this inflationary concern reappearing perhaps, what Trump could mean for inflation, because that overall set of policies are quite inflationary if he starts to stimulate, if he has enough fiscal control to boost demand, have policies that boost demand, have policies that are supply side, what we call supply side policies, things like immigration policies changing, how that might impact the labour market, wages and inflation. So I think the market focus will start to eventually shift towards focusing on the polls, because the polls have shifted a bit since the announcement of Kamala Harris as the Democratic nominee. Who is her running mate? Is this somebody who comes from the Rust Belt, someone who can pull out some Republican support? That will become a focus very soon. And also, not specifically the polling within the swing states because of the Electoral College, and how very few states can really just determine who becomes the president in the US. And I think those will start to become much more market influential over time.
And I guess looking even into 2025, depending on the presidential election outcome, there's that sort of inbuilt tension between what the White House might do in the Fed, because, whether it's somewhere between 25 and 100 basis points, depending on how pessimistic you feel in terms of cuts by the end of this year, that then gives the Fed room to hike rates if the US starts to stimulate inflation, whether that's through tax cuts or tariffs, which means they start to import it, or gumming up the works as far as the job market goes by limiting immigration. So there's that challenge to come, which will be interesting, if nothing else.
Yes. I think it will be there'll be, as we've seen this week, there'll be speculation. Yes. I think markets really move on speculation. So there's what we economists can say, okay, this is the evidence we have, but it's a sentiment that's really going to be quite important.
And then I guess it's always, from an investing point of view, it's trying to back out the probability weightings from markets, and any shift in what's priced into the reality is essentially is where where traders make their money. So something to watch out for. How do you put this all together? Because from this conversation, and my personal view is, over the last 24, 48 hours, I've sat on my hands, I watched things go down, I've watched things go up, and I have thanked my lucky stars that I am among the most passive investors out there. So how do you put this all together? How do you look through this noise? Is it noise? And over the next 3, 6, 9 months, and then with a long-term hat on, how do you?
Yes. So a little bit about the process and our framework, actually. So obviously I sit within the economics team, but we work very closely with the strategists and the portfolio managers as well. And we have a quarterly investment process, but we have continuous dialogue as well. So the framework, really, you need to think in terms of time horizons, as you've highlighted. So we call one phrase as strategic asset allocation, which is a very, very long term. You're looking over multiple years. And we work with the teams to pull together some long-term expected returns for the different markets based on our different regional coverage. Yep. So that's one contribution that we would have, as well as looking at what a central bank's going to do over the next month to 2 years, etc. And then we'll forecast growth and inflation, but we also look at that longer-term expected return as well. So that helps with our strategic asset allocation process. But then there's also a tactical asset allocation as well, which is a much more high frequency. But still, it wouldn't be responding necessarily, like it is a case of looking through the noise, but having some sort of protection in place. So when valuations were looking a bit stretched, to put some protection in place at that time. So that's why we need this constant communication and analysis, monitoring of markets and the economic data. So that's how we work together with the portfolio managers and the strategists. but really, in terms of how you position, I was talking to one of the PMs earlier today, and really it's a case of diversification is really critical. And having a multi-asset, multi-culture, multi-country, multi-sector approach as well. So that diversification there can really help weather some of the storms that we've seen in terms of these, particularly in the summer. And we've all been very wary going into August that there's a lot happening. At the moment nobody's focusing on the Middle Eastern tensions, but that's something that could re-emerge at any time. So we were monitoring that last week. So it's really looking at the economics and the politics, and we have a political economist in our team who focuses on all the global political picture as well, Lizzie Galbraith, who is critical to creating an overall view and asset view.
Fantastic. Yeah. Switching gears, because you've had a fantastic career to date, 25 plus years, and I want to ask a few questions about that. I guess maybe just to start, because you've mentioned politics. To my mind, the role of an economist didn't involve politics, and politics didn't matter. And now it's tough to be an economist that doesn't have a view on politics. How have you tried to compute that into your work, into your career over the years? How's that changed?
I think that's right. It's one of the big changes, I'd say, over the last couple of decades is, I remember when I started, it was looking at models for different asset classes or models for economics. And then when we did look at politics, it would be, the impact of Middle Eastern tensions on oil markets, commodity markets, or, But really it's, I'd say since probably before, it was around 2014 onwards. And it would start with, some emerging market economies, but really Brexit was the big impact on my career, really, in how a political issue within the Conservative Party then became a country issue, and more of a story about globalization and changes in that globalization trend. So that's been quite important to really understand the details within the trade negotiations. So I did cover UK economics in a previous role in a previous company, and yes, this is a very different. This has just become a bigger issue, obviously, with trade constraints. I mean, we had Trump 1.0. We're now considering Trump 2.0. And the Middle Eastern story is unfortunately still there.
What about, I guess, on the other side, are there things that really mattered at the start of your career as an economist that just no one cares about anymore, or the computers do it all for you? And
I think overall, so my career I've had slightly different roles. So I started my very first sort of industry job was as an FX strategist at State Street Bank, and that was just an internship while I was doing my PhD. So I took a year out and did this role, and it was really fascinating. And as an economist, you can be, there are different things you can do. You can go into academia or civil service or markets. And this really sort of...
I think you chose the best of the three.
Having
really, interned in the civil service, I'll tell you for free.
It would really open my eyes in terms of how it can be very practical. It makes economics come alive, and it's very instant. You can see it on the screens, the reaction to different data. So it was, I would say that the fundamental analysis that we do, the skills that you need, are pretty much the same, but the environment has changed.
Okay.
So I would say that there's a lot of regulatory changes which came in with, particularly with the great financial crisis. Okay. So that has impacted a research role to some extent. So when I was working at an investment bank before, there was less. There were more restrictions in how you could relay your research. So you had to publish before you can speak to anybody. Yeah. And that change came over time. So before you used to just shout things across. We had a squawk box where you'd speak into the speaker and it would just blast out across the trading floor. That had to be contained. You publish it first and then you can walk over and talk to people about your research. And I say on the buy side, it's a bit different where you can still communicate with your PMs as things are happening, and then you can publish things and it's a bit more fluid there. So that's a big difference. But I would say the regulatory change is a big part of it. And obviously tech changes, but the fundamental knowledge that you need is still there. Even with AI, just say AI can replace everybody's jobs. You still need to see, fact check this, and you need that knowledge base and the skill set as well.
Okay, got you. So I'll just ask the question outright. What makes a good economist?
Well, I guess there are different types of economists. General skill set for any economist would be, I'd say, quantitative skills, good knowledge of different theories, knowledge of, the business cycle, understanding how different economies work and how things can change. So that would be one side of it. Good communication skills, actually. You need to relay that to different audiences. And I'd say if you're if you're in a markets-focused business, like an asset manager or an investment bank, you need to have some knowledge of markets as well. And I think that really helps. And that comes over time. I didn't have that when I first joined first joined a bank. So I started from having a very academic style of research, and then I very quickly changed.
Yes.
So I went into, so I started in FX strategy, and then I moved into asset allocation strategy, which was one of the best moves, I think, that in terms of the knowledge base that I gained from that. And you really, a lot of these presentations or slide decks that you'll see from different research teams, it always starts with the macro. So having an understanding of the economy is so important, and then you can look at how that translates into different trade ideas or allocation ideas.
What makes a good leader?
I think the obvious ones, you need someone who has a good vision and direction. But also I'd say communication is very key, being able to communicate with your team and being able to motivate your team to be on, to all move in the right direction. And that comes with clear communication. I'd say maybe something a little bit underrated, listening and empathy as well. Everybody has a different style of research or different style of working, or different things that motivate them. So it's really understanding the people who you're working with, and understanding your teammates in other teams or colleagues in other teams. What do the PMs need? I think it's a variety of skills, really. I wouldn't say there's one skill that for me that really overpowers. Just thinking about all the people that I've known that are really good team leaders, I'd say they have this combination of skills. It's quite a holistic process, I think, to put together a good team.
And then maybe lastly on this category, what makes a good investor?
I think having a very good objective framework is really important. So I was talking to a PM recently about, these questions in terms of frameworks and things. And, really it's about having, taking out the emotions, having a very strong framework of whether it's strategic asset allocation, tactical asset allocation, having a clear time horizon, clearly defined objectives in order to put this, make those decisions. Yeah.
Cool. Okay, we're almost at the end, Sree. I just want to close with our famed lightning round. So short, sharp questions, short, sharp answers. What was your first investment?
I think my first investment where I was lacked confidence as well. So I maybe bought. It was an actively managed fund, which was quite diversified, and I thought, well, I'll invest in this one fund.
Okay.
And then over time, I became a bit more confident and would invest in trackers, and but again, always very with a longer term view.
Yeah.
And sort of, if once I understood, but initially it was just a managed fund.
Okay.
Yeah.
I think I might know the answer to this. What was your worst investment?
I tell you what I think. I mean, there were lots of, you can make, you could say that best investment last year would have been Japan.
Yeah.
Worst investment this year would have been Japan. You can say those things. But I'd say markets move up and down. But my biggest regret is not entering markets sooner, because you have that opportunity cost of waiting. Yeah. So again, that when I mentioned that lack of confidence in, I might lose my money. I think it was during my asset allocation job, actually, when you look at the charts over time of
you just realize
inflation adjusted.
It goes up and to the right.
Inflation adjusted equity returns versus cash returns over like 10, 20 years. I mean, it's a no-brainer to just invest as soon as possible, and being a bit more aware of your pension allocation as well. Don't just hand it over. Have a look and make sure it's got the correct risk target for your. If you have a long time, if you're young, you need to have more risk in your pension.
I'd add to that. Well, this is not financial advice, etc., but more than risk allocation, especially if you're young, it's more fees.
Yes, fees, very important.
Because those will kill you. And you've got plenty of time to make up anything that you've lost or whatever. That's kind of the whole point of investing sooner. Yep. But those fees will completely wreck your plans.
And reinvesting income as well.
Drips.
Accumulating that income is really compounding is really important.
Okay, you've been honest, so you get the good question, which is what was your best investment?
My best investment.
You can't say Apple in 82 or something like that.
No, I wish. Okay. I think it was during like that 2005, mid 2000s. Yeah. It was looking at that sort of China story. Okay. I did go into some commodities at that time. Okay. So that was and I just held it for a while. But then I remember looking at some scary signals where oil had really stretched out, and I think it was around 140, 150, and some airlines were hedging at really high levels. And I thought, I'm not quite sure about this. And there were some credit signals. I thought, maybe I'll just sell that now. And I think that was, that was quite a good.
That is good. Okay.
But again, it was looking at a structural driver, and I think that's something that's quite important to sort of take a story that will run for a while. Yeah.
Otherwise, you're stuck. Checking things every day and no rest. Is there any investor out there that you admire the most?
I think there's some big name investors. I think it's important to follow some of those big name investors. For example, Warren Buffett selling Apple shares, or that can move markets. I think there are a number of those investors that we can all follow. But I think I've been really lucky in working in this industry, and just some of my favorite investors are actually people who are colleagues or ex-colleagues. Is it okay to name drop somebody?
Yeah, fine. Yeah.
But the PM that I've mentioned a few times is a lady called Katie Trousdale, who's the head of Investor Solutions. And, she's a personal role model as well. And I would say that, just her approach, again, very objective, diversified, taking a good fundamental story, somebody with a good framework like that, I think, is someone that you can constantly go to for discussions and questions and, talk about what's happening at the moment in very calm, clear mind, to discuss things with. I'd say that would be how so people I've worked with, I'd say.
Fantastic. You've already shared a ton of advice, not financial advice, but in terms of taking a step back, thinking about the bigger picture around what's been going on in markets, around central banks, around being a good economist, investor, leader. But is there a cherry on top of that cake in terms of advice you wish you'd received maybe at the start of your career that you'd maybe want to share with people?
Actually, yes, from a research perspective.
Yeah.
I think I was also coming from an academic background. I was very, one of those quiet, nerdy types.
Okay.
I always had my head down and just get on with my job and things. And I would say I wish I had started networking a bit sooner. So learning to build your network, going to those drinks after work a bit more.
Yeah.
And also learning to sort of talk to people about what you're working on, because if you don't tell people, they don't know.
Yeah.
So you have to learn to sort of, advocate for yourself a bit more. So I'd say networking has been really important. Influence.
I like that you said learn to do that, because it's one of those things that people say, oh, just go and do it. But it is a skill you have to learn.
It's a skill, and you do it slowly over time. There's no right or wrong way.
There are some wrong ways.
Okay. But within your comfort zone, I'd say it's important to step
Absolutely.
up. Yeah.
And finally, where can we find out more about the Abrdn Research Institute and your views, and keep up to date with what you're up to?
So we have a website at abrdn.com. I'm also on LinkedIn. I started an X account, but I've got 2 posts. But mainly on LinkedIn for me, and then
it's probably for the best.
Yes, so that would be the website would be the main place.
Fantastic, Sree. Lovely having you on the Finimize podcast. Thank you so much for joining us.
Thank you for having me.